Inflows into bond funds have been strong all year and have been accelerating since the big market drop. The ETF industry is developing new products to help investors generate a steady stream of income from their bond portfolio. Let's talk about that with Nate Conrad, head of LifeX and LifeX ETFs, a suite of longevity income ETFs, and with independent ETF expert Dave Noddick. Nate, you follow bond flows very carefully. Big inflows from investors that have been seeking a safe haven. We've been seeing that all year, but investors have been confounded by this recent rise in yields that we've been seeing in the last 4, 5, 6 days. What's your take on what's happening with bond yields?
I think there are two big questions on the market's mind. The first is inflation. What are we going to see as the playthrough from tariffs into long-term inflation? And the second is about foreign government investment into our debt. They're one of the biggest owners. And if we shrink the trade deficit, is that going to reduce their investment in our bonds in the future?
Yeah. So, Dave, let me get your take on this. This rise in bond yields is really a bit of a mystery here. He has a couple of explanations, Nate does. But lower growth, if that's what we're worried about, usually means lower interest rates. Yet since the stock market chaos of the last week or so, yields have been rising. Can you give us your take very briefly on why yields are
couple things. I mean, clearly we're going to have less trade, and when you have less trade, you need to finance less trade. Historically, people have needed to finance dollars. That's why every country in the world buys U.S. treasuries. It helps them manage their international trade with the United States. So if we're slowing down the amount of international trade, we should expect in aggregate the holdings of bonds to probably come down. The same is also true for folks who are just doing things like the basis trade, buying a bunch of treasuries, shorting a bunch of futures. That trade's unwinding too. So all of these capital holding requirements that led to buying U.S. treasuries are kind of unwinding at the same time. So the traditional math of things are bad for stocks, everybody's going to buy bonds, just isn't working out this time, because the kind of shock we're seeing is one we've never seen before.